Alright, so let's begin the show. And millennials are betting big on SIPs and they have unwavering interest in mutual fund industry. Recent reports suggest that the COVID-19 pandemic coupled with the increased adoption of digital technologies has sparked interest among millennials to invest in the equity markets. Let's understand all of this and let's talk more on this with Manu Prasad, the Chief Marketing Officer, Scripbox. Manu, good evening and welcome to the show. So let's decode the data first. What's outstanding and what's striking in the CAMS data that's come out, where millennials are showing their increased interest in investments in equity through mutual funds? Manu, hi, can you hear me?
Yes, Kavita. Good evening.
Hi, good evening. So I was just asking you that let's decode the data and what's different and what's so unique and striking in this data that you see for the first time. I mean, the trend of millennials investing in equity market has been going on since the pandemic. We've seen the number rising. Talking about this data, what's striking?
I think the fact that in the last 5 years, practically 50% of the people who are coming in to invest for the first time are millennials is itself a big deal. And I think this is due to a bunch of factors. Obviously, like you stated, the pandemic has had its effects. It did provide a jolt, both in terms of the need to be prepared for finances, as well as the market boom that followed immediately after. But I think what is heartening about this entire thing is the maturing of the ecosystem. And I look at it from three aspects. One is from a distribution point of view, where there is an abundance of information about different investing venues, different products, all of that. And there is accessibility in terms of the ability for a millennial investor to invest easily, whether it's online or offline. In terms of product itself, the financial products that are becoming increasingly attractive because of the growth factor, there is regulatory oversight that assures safety for the investor's money. And when you really compare to other products and look at it in terms of tax efficiency, risk-adjusted growth, etc., it actually becomes sort of what we call TINA. There is no alternative, right? And to help all of this, AMFI has done a phenomenally good mutual fund Sahi Hai campaign, which is built on great insights on what really customers are feeling, what exactly they want. So together, these are some of the things that have driven the overall investing trend for millennials. So a bunch of heartening statistics once you start looking at the study. And this is reason to believe this is more of a long-term effect and not really something that's a blip in the chart. For instance, 67% of people have gone ahead to the SIP route and not the lump sum route, which means that they are looking to the long term for investing and not really looking at a one-time payment or a one-time investment for the short run. 95% of the users have chosen advisors or mutual fund distributors, which means there is an intermediary who's also looking out for the interest of the user. 29% of those who have started with lump sum investments added an SIP. And the reverse is also true. People who started out with an SIP also did a lump sum.
Right.
There is also a lot of diversification happening, not just in terms of mutual funds.
So let's get into the specifics over here now. Since you've elaborated so much on this data, so we've seen the numbers going up through SIPs. Okay, that's one clear-cut interest that we are seeing. Also, women participation has increased, and almost talking about millennial investors, 30% is women. I want to understand from you, as per your data analysis, as per your research, what is that category in equity where they're investing, even if it's through mutual funds?
Sorry, can you repeat that?
What is the category in equity if they are investing through mutual funds is the most, it's going like hotcakes?
So at least from the data, what looks like is that flexi cap is doing very well, and so are small caps. But long term, which is large caps, etc., are also not doing too badly. It's a fairly even mix with about 20% for flexi caps, followed by about 13% each for small cap. Sectoral funds are doing well as well. That's probably the highest percentage that you can see. So this is the average mix of the investor.
Concern over here is the millennial investors that we are looking at are still urban-oriented investors. Although the entire equity participation, if we have to look into data post-pandemic, we have seen mid and small towns also doing good. I mean, we've been seeing participation in equity through mutual funds even from those small towns and mid towns, okay? But then when it comes to millennials, it is still urban. Do you think this spreading to mid and small towns, also tier 2, tier 3, or you think that this phenomena is very urban based, where people are much more educated and maybe there is a lot of financial literacy that's going on?
At this point, it looks like it is urban oriented, but I believe in the next 3 to 5 years, we will see a shift towards, or at least a greater share of rural participation in this B30. And this is probably following pretty much where the internet goes, whether it's in terms of e-commerce or any other service provided by the internet. It's a function of the macro context. Obviously, there is employment, there is income levels, general awareness, like you suggested. Also, the cultural attitude towards different kinds of
when
savings.
it comes to following social media influencers and influencers, I'm sure even you will agree the reach of internet is great. Okay, so I don't think there's a point we should be really thinking much about it. Yeah,
I understand.
Yeah,
no, absolutely. If you look at it from if you look at who has cracked the overall millennials, adding to the investments, you're looking at RIS who have probably got a huge share of it. It's about 35%, right? In their share of B30 millennials is about 1%. Even if you look at the next year, which is banks and MFDs, it's still less than 30%. So I think it's a distribution problem more than anything else. I think one solution that will crack it in the near time frame would be digital, right? The level of paper usage in the operations of mutual fund investments is 80% in B30. Whereas it's 15% in urban. So the entire idea of distribution, the accessibility to investing and the accessibility to quality advice, I think that is what will swing the pendulum in favor of the B30 towns in the near future. Because I'm not saying there will be a saturation of T30 in the overall investing scenario, but I think we will have to get down to B30 for us to start getting more and more investors. So it's a matter of time. It's not a if or a it's not an if, it's a when.
So, looking at this data, are you able to figure out that are we moving towards financial literacy, or is it just the pandemic post impact that we are looking at now? And obviously, these people who might have invested during the pandemic and now the market have been volatile and giving a single digit return. So the volatility must have really impacted their portfolio also. But do you think this particular trend is moving in a direction where we really want investors to be financially aware and educated about their investment, or you think it's just a one-time phenomena which might sustain but then in a very patchy manner?
I don't think so. And I'm specifically looking at the cohort behavior of 2019 to 2023. And we have at least 5 years of data for the first cohort, which is the batch of 2019, right? At that point in time, the first time investors actually added 10 lakh SIPs. And in the same year, added on another 4 lakh SIPs. And if I look at the subsequent years, 2020 to 2023 financial years, they have added collectively about 21 lakhs of registered SIPs. That's probably a 3.5x jump in about a 5-year time frame, which I think is phenomenal. And if I look at 2020 and the subsequent years, you can practically see the same pattern of investment. So people are continuing to invest. And even this year, the numbers are reasonably high. So it's not as though you're looking at a very short-term blip and saying that, okay, pandemic provided a sort of bonanza for equity investors and therefore they are staying only for the short run. I don't think it is that. So we will see this as a trend. Like I said, I think these are the signs of a maturing investor ecosystem where people are looking at the long term, people are looking at the different options that they have, and then considering very carefully. Like I said, 95% have an advisor or a distributor. So there is an intermediary that is also offering quality advice, and that will be the difference maker going forward. That the quality of the advice that you get is going to make you stick to the market or not. And on that, I'm very confident.
All right. So moving on, and maybe this is the last question now. Do you think these millennials are investing with a very goal-based strategy, or because it's through mutual funds? I mean, that's the basic way to invest in this particular asset class, equity, if we have to enter through mutual funds. What do you have to say about that?
So we don't have particular data on that in this particular report. But what we do have is the other studies that we have done. For example, the Family Day survey that we recently published. The interesting part that we have seen here, and it is related to what you said about the increasing participation of women in investing. what we have seen is that women are far more goal oriented, whether it is to do with short term things like create an emergency fund, or even in terms of long-term goals like children's education and retirement. And there's not a gender comment, but men are far more biased towards getting better returns and looking at it from a very portfolio angle as opposed to a long-term objective. Most people in that sense are a little less structured in terms of goal-based investing and are more in from a portfolio returns and what is the best way to grow my portfolio and looking at a particular large sum to take care of their long-term needs, whether it's education, retirement, buying a home, any of those things. So I see a gender difference there and not necessarily a millennial difference, although I think the millennials as a cohort probably are more aware of the needs that they will have later in life, and therefore they are structurally preparing themselves for those long-term goals, even if not specifically investing for that.
All right, that will be all. Thank you so much, Manu Prasad, for being on the show and helping our viewers with this data. And on that note, let's take a quick break. Post that, we'll be talking about group term life insurance. Welcome back. You're watching The Money Show with me, Kavita Thapliyal. Fintechs and digital technology are transforming the investment landscape in India. That's the word coming in from Navneet Munot, MD and CEO HDFC EMC. My colleague Anurag Shah caught up with him for an exclusive chat. Listen in.
Of course, I think thanks to Jan Dhan Yojana, Aadhaar and mobility, the gem trinity that got created in India, which provided access to more than 1 billion people to the mainstream financial system. And now in the last couple of years, what we are seeing is, I would call this a Jan Nivesh, though this is not a equivalent of Jan Dhan Yojana, but I think the awareness that it's not only important to save, but also to invest it rightly over the next several years. And I think mutual fund sahi hai, this campaign, which has created a lot of awareness about investing for long term, along with a good track record of mutual fund schemes over a long period of time, the transparency that this product has, and of course the technology put together, all of these forces have made this possible, that the number of SIPs, which used to be around 60 odd lakhs 10 years back, have reached now 6 crore plus. In fact, in last 5 years, the SIP monthly flows have doubled from 7,000 crores to over 14,000 crores now.
Just that due to the fintech, the average size of SIP has increased, although economy is growing. But does that data suggest that due to fintech, the average size of SIP has increased?
No, in fact, the average size of SIP brought by fintechs is lower than the overall average. The overall average SIP size would be around 2,300 rupees, but the average SIP ticket size of fintechs would be less than 1,000 rupees. Okay. These are a lot of new investors, particularly in the younger cohort. In fact, for one of the large fintech, I'm told that 15% of their investors are between the age of 18 to 23, one of the larger fintech. And the average ticket size is lower for the fintechs than the industry average.
Recent data suggests that the now retail investor is going away from market, that peak has come and now there is not much of scope.
India is at such early stage of growth, how a peak can come. I mean, markets of course would have their ups and downs, but I think as an economy we have a long way to go. As markets, I think we have a long way to go. I think we should not get swayed by the short-term volatility, but as we keep saying, I think the best way to invest is for the long term. I think do the systematic investment, planning, and that's remain disciplined and don't get swayed by the volatility. Make the best of the, take the advantage of the volatility.
All right, so that's the word coming in from Navneet Munot from HDFC EMC. But then let's move on. Group term life insurance plans are designed to offer life insurance to a group of people under a single policy. But should you consider opting for group term insurance? How do they differ from other insurance plans? Let's answer all of these questions. We have Kapil Mehta, co-founder and CEO SecureNow.in. Kapil, good evening and welcome to the show. Just to get a general sense, what exactly is a group term insurance policy?
A group term insurance policy is a term life, which means that if somebody dies, then there's a benefit, large sum of money which is given to the nominee. But if a person survives, then nothing is given. And it's a group term because it's typically issued, a company buys it for its employees, or a group buys it for its members. So it's bought by a company rather than by an individual.
So is this a kind of policy that usually employers offer to their employees?
Yes, it's becoming increasingly common. It's not yet as common as a group health insurance, but more and more companies are offering it. And typically, the company will buy it and offer it as a benefit or a perk to its employees.
So Kapil, as compared to a standalone term insurance policy, okay, that an individual take, if I have to compare a group term life insurance policy, in terms of sum assured, in terms of your coverage, in terms of your premium, in all these parameters, how different is a group term insurance, and which is better?
Well, there are some advantages to a group term and there are some advantages to an individual term. If I can just give you a sense of the group term first. The big advantage that a group term has is that you don't have to go in for medical tests, and the entire group is covered immediately. So that's a very easy way to buy and get access to term cover. That's the benefit of it. Because a company is negotiating the rates, they tend to be competitive, and you tend to get lower rates than what you would get as an individual. That means they're cheaper. And third, if there's a claim, then again the company helps out, and the claim gets paid to the nominee. So it's an efficient insurance to buy. However, individual term has some benefits in the sense that it is your personal insurance. So tomorrow, if a person were to switch a job, or the company were to change its policy about giving group cover, then if you have your individual term, at least you have the financial security that something happens to you, the money will come to your family. So I do believe that it's very important for people to have their individual term plans and not depend only on the group term cover. But if the company gives you group term cover, that's great. It's sort of an add-on that you must have and must value.
Kapil, if you are not with an organization, you will not get a group term life insurance policy?
Generally not. I would say that 95% of the group term policies sold in the market are what is called an employer-employee term life. That means you've got to be working in a company, and the company must want to give that benefit to you. The 5% which remains are what we call non-employer-employee groups or affinity groups. Those are very rare. And an example of that is that, let us say that you are part of a trust or an alumni association, and the association buys the insurance for you, then you can get covered through that. But those are very difficult to get, and those are very rare. By and large, it's exactly what you said. It's an employer-employee relationship.
What about your medical test and prerequisites and other things, which are taken into account before issuing you a life insurance policy? Is that all applicable when you take a group insurance policy, a group term plan?
No, it's not. So that's in fact a big benefit because, medical tests are by and large not done when you buy a group term life. And there's an exception to that I'll tell you in a moment. But this means that, if you're suffering from some chronic condition, and that chronic condition could be anything. It could be diabetes, thyroid, you may have had a heart attack, whatever it is, you'll still get issued the group term life. Whereas you may not get issued the individual term insurance, or you may get those plans at a higher premium with what is called a loading. The exception to this is that there's a term in group, when you buy a group term life, which is called the free cover limit, colloquially known as the FCL. So the insurer will put a threshold of sum assured, and that's generally a high number. It may be 25 lakhs, it may be 40 lakhs, it may be 50 lakhs of sum assured. And as long as a person is below that in terms of the benefits offered, there will be no medical test. But if somebody falls above that, then they will have to go through a medical test. And increasingly what I find is that most insurers, what they do is that, let us say there are 300 employees in a company, they will set the free cover limit so that at least the one or two most senior people with the largest sum assured have to undergo a medical test. But for the vast majority of people, there's no medical test, and actually that makes it a very easy insurance for them to buy and to use.
The claim process, Kapil, what are the formalities that one needs to opt for? What's the procedure? And how different it is from an individual term insurance?
Essentially, if the employee dies, then the insurer will like to check a few things. The first thing they'd like to check is that the person has died. That's obviously a basic thing. And who has died? Is it the person who was insured who died? Then they would want to check that what is the level of sum assured or benefit which was there in the policy. And that's because they generally want the sum assured to be not more than 10 times your salary income. And they sort of check that at the time of placement, but they recheck it when there's a claim. And then, of course, they'll ask for details around the person's bank details where the money can be paid, and also a list of who the nominee is, typically a close family member. So these are the 3 or 4 bits of information they would ask. They're very easy to put together. And once you get this, the money is actually paid out quite fast. There are a large number of insurers who commit to paying your death claim within 24 hours and actually deliver on that. In terms of requirements, these requirements are very similar to what you have on an individual case. In an individual case, if you have an early claim, that means you buy an insurance and you die in the first year itself, then that is subject to a bit more scrutiny. And sometimes there may be more documents, or there may be a small investigation and due diligence which is done. That generally does not happen in the case of a group term life.
Can I increase my sum assured for a group term life insurance? Because obviously, as we discussed also, we've established that you really need a separate term life insurance cover, which should be at least 10 to 12 times your annual package. Should also cover all your risk liabilities and financial liabilities in case you're not around. Can I increase my cover, my sum assured for group insurance?
Yes, you can. So in fact, the benefit in a group insurance can be a level benefit across the company. So a company may say, look, everybody is going to get 10 lakh or 20 lakh of death benefit. Or it may be a graded sum assured, where they say persons of so-and-so seniority get more and persons of so-and-so seniority get less. Or it could be linked to your salary. So there are different ways of structuring the benefit. It's quite flexible. And so if at the time of placing the policy, you can sort of make sure that you get a high sum assured. If you have a certain sum assured now and then you want to change it in the future, these group term lives are renewed every year. It's a 1-year contract. So when the policy gets renewed, you can sort of get a higher sum assured at that point in time. This is different from an individual term life, because individual term life are not 1-year contracts. They're very long-term contracts. Could be 10 years, 20 years, 30 years, or till a certain age. So once you fixed a sum assured in an individual term plan, you can't change that particular sum assured. You can buy another term plan to supplement it, but you can't change the sum assured.
What would be the premium that you might have to pay? This can be less than an individual term policy, right?
It'll typically be about 10-15% less. Maybe not that much less, but 10-15% less. And the advantage being that you don't have to go through medical tests when you get the policy. To give you a sense of, the premiums depend upon age, like a term plan does. Older people pay higher premiums.
So even if yeah, please go on. Yeah.
But generally, if one want to say what the average costs work out to, they work out to 3 to 4 rupees for 1,000 sum assured. So if you want 1 lakh of cover, it'll cost you about 3 to 400 rupees. If you want 10 lakhs, it'll cost 3 to 4,000 rupees. That's a sort of very rough ballpark number that I'm giving you.
In the case of a smoker, non-smoker, that condition is not counted in a group term life.
No, so that's actually that's also a benefit of the group term life, because you don't ask whether the person smokes or doesn't smoke, but you always ask that question in the case of individual insurance, and in fact load up the premium for somebody who smokes. So in group term, it doesn't get asked and not checked for.
A tax benefit if you are as per the old tax regime?
You don't get a tax benefit in the case of a group term life, because the company is availing of a tax benefit, through the expense reduction. So unfortunately, that's not a benefit. For that, you have to have your individual plans where you can sort of claim a benefit.
All right. I think, Kapil, that will be all. I think we've covered all the aspects of group term life insurance. Thank you so much for being on the show and helping our viewers with that.
Thanks a ton. See you.
Thanks. We move on and let's talk about mutual funds now. Mutual funds are one of the best ways to invest in equity market and grow your wealth. But what is the best time to invest in the market? What does past data and trends suggest regarding the ideal time to put your money in the markets? We caught up with Feroz Aziz, Deputy CEO, Anurati Private Wealth Management, to discuss all of this. Listen in. Mutual funds are one of the best ways to invest in equity markets and grow your wealth. But what is the best time to invest in the market? What does past data and trends suggest regarding the ideal time to put in your money in the markets? Let's understand all of this with Feroz Aziz, Deputy CEO and Rati Private Wealth. Feroz, good evening and welcome to the show. So, are we timing the market here?
Kavita, yes, more or less, you're not timing, but you're at least trying to decipher if there is some better, relatively little better time to invest. That's what we're trying to see if the data crunching helps us just get the little tad more,
right.
If possible.
Right. So let's get the data from your research team. What do you have to say? Like, maybe if someone is a first-time investor and just to the equity markets, in a year's time, you say that there are specific times when you should, and in fact, if you do, you can really yield the wealth in a longer-term perspective. How many opportunities are we talking about over here in a year?
See, Kavita, one thing which has come out reasonably clearly is that the initial parts of the year are great times to invest. Not scientifically proven, but this is reasonably good evidence. Like you see, January, last 5 Januaries, all of them Nifty has been negative. So that's not just a coincidence. If you look at 14 months, 14 times in January, out of the total 23 times Nifty has been negative. But in the latter part, you'll just find about 8 to 9 months out of the total 23 which have been negative. So Jan, Feb, March and April are relatively great times to invest to get that 0.5%, 1% more. Basically, because April is also a part of that, I think bonuses coming and lump sum investments during those periods when you top up your SIP folios with some additional units which you buy one time could be a good strategy. That's point one. Point two, the age-old myth which has been there in the capital markets is December is a bad month for the markets because the FIIs want to wrap up their show before Christmas. That clearly is exactly the opposite. The maximum number of months of the December is the maximum positive months over the last 22 years where we have seen. But the contrary to the belief that December is a slow month for equity markets.
So, Feroz, these timelines are specifically for those people who want to start their investment journey, or is it even applicable for people who are into regular investing, maybe through an SIP, or they have their schedules on track?
See, I think, Kavita, this is more information to somebody who is a little more seasoned investor because I think efficiency comes in second. First is to begin. Most investors who keep procrastinating and not invest, they should begin to invest. Then you try and see if there were some little efficiencies possible to make it a little better. That's for a graduated investor. So point one, if you're a new investor, you should begin your SIP come what may. Second thing is you have to be patient with your SIP. Markets have this tendency to test your patience. When your patience is least, the probability of making money is the highest. There's enough evidence to give a merit to this case. So if you look at COVID, when all hell had broken loose, most people had given up hope. But the subsequent year, Nifty went up about 70% in FY21. So when all hopes are lost, is when market gives you a springs you a surprise. Like just a couple of months back, whenever I speak to any market participant, they were very pessimistic. And that's when I thought this pessimism actually indicates that the market will go up. And it so did. And we are back to 18,400 kind of levels today. So point is, be patient, start your SIP. If you're a new investor, irrespective, just start. And I don't think it'll disappoint you over the long run.
Going with these observation, Feroz, now if you have to invest in the first 4 months, like say someone has tried putting their money maybe in Jan, by end of the year, how much do you think they could land up earning? Because looking at the observation and the trend analysis, first 4 months are clearly the best months, if I can say, to invest.
A good month to invest because of the market being subdued. That having said, even if in a mid-month, mid-year, let's assume July, if you get a correction, every time you see falls of 5, 8, 10% in short spans of time, you should always try and empty your bank accounts and move that into equity. irrespective of which month you are in. But 4 months are definitely reasonably good because they've been more negative than positive. So when you accumulate units when the units are cheaper is always better. Now, of course, it's a little more courageous decision to do when markets are down. Putting in money requires steel nerves. Please exhibit those steel nerves and the markets will reward you. Having said which, Kavita, if you look at how capital markets or equity markets are little more perceived to be more riskier than they actually are. If you look at these 22 big years of this century, there are only 4 calendar years when the markets have been negative. The 18 other calendar years, markets have been positive. But when you speak to market participants, they think there's a 50% chance of losing money, 50% chance of making money. 81% of the years in this century, calendar year wise, markets have been positive. So, thoda zyada badnaam hai equity market, more than the data throws out.
Right, but then this observation or these trends are also visible on your fund's performance. Do they mirror? Is there any reflection?
See, when you look at fund performance, it's a very diverse universe, Kavita. Most of the shows you always say there is a plethora of funds, and those plethora of funds behave very differently. You're so right when you say it's so difficult to choose from 380 active funds. 380 active funds. Take a minute to fathom this number. Those are the number of active funds. If this is the universe, the best and the worst every year have a 30% difference in performance. So it will not be right to say all of them mirror the market. Like last year, the best and the worst fund in these 380 active funds had a 45% performance difference in a single year. In 365 days, the best and the worst had a 45% difference. So there'll be some who do worse off, significantly worse off than the market. There could be some which would do significantly better off from the market. So scheme selection is one skill which people can't ignore and underestimate the power of scheme selection.
I can see there are some fund recommendation also coming from you. These fund recommendations are based on what criteria? The performance?
No, Kavita, see, performance is a very clerical thing to do. You can arrange all the schemes in the descending order of performance and choose them. But that's like chasing your own tail. We have realized and we've done some study to see that funds are very cyclical. They're very cyclical. If they're cyclical, then you can't choose a fund and stay or choose a fund on the basis of past performance. We also had done a study a few years back. Out of the top 10 schemes of the last year, only 2 of them remain top 10 in the next year. So 8 of them slip from the top 10 category. If past performance is not going to be indication of the future, so what should that be? The criteria be? So we do a lot of analysis in terms of some degree of statistical variables are tested using regression model, which is proprietary. We also try and find out what is there in each scheme stock-wise and find out the targets of those portfolios and several other steps of subjective and objective evaluation, which are more forward-looking than backward-looking. On that basis, we choose some schemes which become the model portfolio schemes for that particular year.
Welcome back. You're watching The Money Show with me, Kavita Thapliyal, and there are plethora of funds available in the market to invest your hard-earned money. But how do you assess which is the right fund for your portfolio? What are the criteria that one should look at? To help you navigate through all of this today, we have on board Pankaj Matpal, MD of Pure Money Managers. Also, do not forget to send us your portfolio queries on our WhatsApp number, which is 865-797-4571. You can also email us your queries on themoneyshow@etnow.tv. Good evening, Pankaj, and welcome to The Money Show. And we have our first viewer online with us, Sanjay Chaudhary. Sanjay, good evening. How are you doing?
I'm fine, ma'am. Thank you.
Thank you so much for sending us your queries. So, we've got your portfolio. Anything else you want to add in this? You have invested in Nippon Small Cap and you're invested in one more fund. Okay. 29 months is okay. And you want to invest more. You have Kotak Small Cap also in your portfolio.
Yeah.
Anything else?
No, ma'am. Actually, my query was that for the similar duration for about 29 months,
yeah,
I have been invested in Kotak Small Cap and Nippon Small Cap.
Right.
So for last 29 months, if I see the record, the return in Nippon small cap fund is much, much higher than Kotak small cap fund.
Did you see the funds portfolio, Sanjay?
I have not really checked that actually.
All right. So your question is why this kind of a difference in your absolute gain figure? But at the same time, I'm assuming that these are the only two small cap funds you have in your portfolio and you are very well diversified otherwise on a portfolio level?
Yes, ma'am.
Yeah, you are? Okay, perfect. All right. So Pankaj, then I think we just need to stick to his query because he is quite sound about his investments. All right. So what's the strategy which a small cap fund manager in these two funds is trying to adopt, which is reflecting in the performance? Because small cap, Pankaj, we know it's a very large universe, and what you pick and choose really impacts your entire return and performance of your portfolio. At a time where there's so much of volatility, so many question marks on so many fronts, at least that's triggered globally. What kind of strategy are these two funds, Nippon Small Cap and Kotak Small Cap, are adopting, and what's the difference?
Kavita, good evening. As you mentioned that this small cap universe is quite large. Beyond 250 stocks, you can invest in small cap. There are more than 5,000 stocks listed in stock exchanges. So here, Sanjay, I will tell you, if you are investing in an index fund, means two small cap index funds will perform almost same because both the portfolios will have same shares. But when you invest in actively managed funds, here the portfolios may be totally different. And one more important thing, see, as per SEBI mandate, a small cap fund will have minimum 65% of its total AUM allocated in small cap shares, and balance 35% can be in mid cap, it may be in large cap. So that is also a reason that your returns may differ from one to another. Here, if you take example of two funds, Nippon India Small Cap and Kotak Small Cap. So if you see the portfolio, one, as I said, that allocation in large cap, if you see Kotak, it has a little bit allocation in large cap as well, though Nippon India have more in small cap and mid cap. So that is one. Second thing about the sector allocation. See, if you see, I just checked here for you, if you see the current portfolio, so Nippon India Small Cap Fund, it has top sectors as capital goods and financial services. But if you see Kotak Small Cap Fund, it has consumer discretionary and material as a top sector in the portfolio. So both the funds are, these two funds are small cap funds, but their sector allocation, their market cap allocation, these are different. But having said that, I will suggest that you should stay in these funds for long term. Right now, you are seeing that one has performed, outperformed another one. Going forward, you may see another fund has performed better than the previous one. So both the funds are good. It's on the matter of time that during this period when you invested, those sectors where the fund had higher performance, higher allocation, that performed well. So both the funds are good, stay invested. And then I explained you the reason why one has performed better than another one.
Sanjay, is there anything else that you want to ask?
No, thank you so much, ma'am.
All the best. Thank you so much. We move on, and Pankaj, we have Rajan's question, and this is through an email. He says that he is a beginner, as in first-time investor in mutual fund. He's 49 years old, and he has a short-term education goal for his son and long-term goal of his retirement, and he wants to understand that how can he achieve these goals. He's a moderate risk taker, and when we say short-term, he says that he has around 3 to 5 years for the education goal, and then long-term 7 to 10 years. He has a corpus of 12 lakhs in his hand right now. So how can he strategize both the goals with this amount that he has? We don't have him on the phone line, otherwise we could have asked him what's the kind of corpus he wants for 3 to 5 years, which is a short-term goal for his child's education, and what is he expecting to collect or want to collect from his retirement goal.
Yeah, Kavita, because out of 12 lakh, how much he needs for the child education and how much for another goal, that is not clear. But still, if he has mentioned that 12 lakh rupees available right now for investment. And for the horizon of 3 to 5 years, and again, the goal is child education, where we can't take much risk. And he has clearly mentioned that his risk appetite is moderate. So for 3 to 5 years, I'll suggest that Rajan should invest in debt funds, and that also short duration debt funds. See, one category is called short duration debt funds. So in that you should invest, and scheme name also I'll mention here. And some part I'll suggest that Rajan should allocate in conservative hybrid funds. Conservative hybrid funds can allocate between 10% to 25% of his total portfolio, total asset in equity. So because we need to generate little better returns than fixed deposit, so considering that fact, I'll suggest that conservative hybrid fund should also be a part of portfolio for 3 to 5 years. So here, Axis short-term fund, and another fund will be ICICI Prudential regular savings fund. So one is debt fund and another one is conservative hybrid fund. Now moving on to this 7 to 10 years investment horizon, and here I'll say that Rajan, you should take little bit more risk of equity, risk of volatility, but because the objective is to generate little higher returns in long term to beat inflation, and schemes will be like ICICI Prudential Balance Advantage Fund, which is a dynamic asset allocation fund. This is also hybrid, but it invests more in equity. Then Aditya Birla Sun Life Multi-Asset Allocation Fund, the fund which can invest in equity, debt, and gold as well. And also one large cap index fund I'm suggesting you. So Motilal Oswal Nifty 50 index fund can be a good choice. So these 3 funds for long term, and rest 2 funds I told you for the short term.
All right, we move on. Do we have Senthil on the phone line with us? All right, so Senthil's query, Pankaj, I think you have it with you, and he's been investing from April onwards, and SIP of 4,000, in which he's doing an SIP in PPFS Flexi Cap, Quant Small Cap, Navi Nifty 50 Index, Navi Nifty Bank Index, and PGI Mid Cap also. All right, so he wants to know if this fund selection is right for him. Also, having a passive strategy for a banking fund, how does that play out? Let me begin with this.
Kavita, I think that banking index fund is a good choice in the portfolio, but not for everybody. Now, here, if you look at Senthil's portfolio, he has large cap, mid cap, flexi cap, small cap. And the important part is that all these schemes have major allocation in financial services, including that flexi cap fund. So if you see the index, Nifty 50 index, it has the major allocation in financial, the top sector, and other these actively managed funds also have the highest allocation in financial services, banking and financial services. Now, adding one more banking and banking index fund, I think then his exposure to banking sector is very large. So in this case, I'll suggest that he can skip easily this banking sector fund. See, if somebody has some allocation in such a way that banking sector is not does not have exposure to that sector, then definitely you can add one. Second thing, when you invest in thematic and sectoral funds, you should know a particular time frame where you want to invest in that sector. So banking sector, as of now, I'll say that if he wants to invest for some time, it's a different thing. But because he had mentioned his investment horizon is 10 years, in that case, my suggestion is that he should stick to diversified fund. This amount what he's investing in banking sector, rather he should add to Parag Parikh Flexi Cap Fund. That is my suggestion to him.
Also, one question that I want to ask you based on Senthil's portfolio, Navi comparatively is a very newer AMC, okay? Should you be betting your money on AMCs which are not very old and, you know, who don't have a great track record of their funds because they've just come into existence, obviously? Can you really trust them and their expertise and the kind of team they have built up?
Kavita, very good question, but here expertise is not required because both these funds in its portfolio are index funds. So index funds are passive funds.
So no,
their
in
portfolio-
general, in general, at an AMC level, I wanted to understand this.
Yeah, I agree with you. See, any AMC, which is the older one, they will have a larger experience of managing funds. Second thing, the fund manager, more than the AMC, even fund managers, that matters when we talk about the actively managed funds. So in this case, it will not matter much. But if you talk about actively managed funds, there the standing of that AMC in Indian market, as well as the experience of fund managers who are managing those funds, that matters. But as I mentioned, in this case, it will not matter much because these are basically index funds. So portfolios are exactly same as the indices.
All right, we move on. And do we have Vibha on the phone line with us? All right, so the question that she's asked you, Pankaj, is she's planning to do an SIP in ICICI Pru thematic advantage fund of fund. Very interesting question. She wants to accumulate 10 crores in 20 years' time with this kind of an investment. So let's just talk about thematic advantage fund. First of all, what kind of a category it is? It's a fund of fund. And later on, we'll discuss as to how she can accumulate this corpus.
See, thematic funds, when we talk about, it means there's a particular theme. It may be infrastructure, it may be power, energy, something like this, where more than one sector, but something similar to that. Now, when I talk about thematic advantage fund, ICICI Prudential Thematic Advantage, it is a fund of funds, a fund that invests in the units of other funds. So this is not one theme, rather multiple themes have been incorporated in this one scheme. So scheme is good, no doubt, because it gives you exposure of multiple themes in one thematic fund. That is what means you asked and I have answered. But if you ask about this question, because this Vibha wants to invest for 20 years, when we talk about 20 years, so your investment should be more diversified. So see, any theme or any sector may outperform the broader market during a particular time period. But if you talk about long term, then definitely one particular theme or sector will not always consistently perform. So diversified funds will be a better choice. So first thing here, if you want to invest for 20 years, I'll suggest you that instead of a ICICI Prudential thematic fund or any other thematic fund, you should go for well diversified funds. And that also large cap, mid cap, small cap, everything should be in a portfolio. Second thing, because the target is very big, you said 10 crore in 20 years. And for that, if I do a simple calculation, it comes to 2,10,000 per month, assuming 12% CAGR. So I don't know, because Vibha is not on phone, so I don't know whether that much investment is possible or not. But it's a simple mathematics. So you can start with whatever amount you can right now and keep increasing with time. And schemes, I'll suggest you ICICI Prudential Value Discovery Fund, which is a value-oriented fund, Aditya Birla Sun Life Multi-Asset Allocation Fund, then Motilal Oswal Mid-Cap Fund, and also Axis Small Cap Fund. Considering that your investment horizon is 20 years, you should have these funds in your portfolio.
All right, quickly, we have a caller, a viewer on phone line, Shiva Kumar from Indore. Hi, Shiva, how are you doing?
Good evening, ma'am.
Thank you so much for sending us your questions. So you want to understand defense mutual fund for 5 to 7 years. Is that your question?
Yes, that is for a horizon of 5 to 7 years. As of now, which is the best defense mutual fund.
A defense-oriented mutual fund that invests in defense-related stocks.
Defense, correct.
Sure.
Correct.
Sure. Pankaj?
See, if you want again the particular sector fund, so SDFC is launching a defense thematic fund, so that can be a good choice for you. But otherwise, if you see all diversified funds, they have allocation in defense sector as well. So if particularly you want to go for thematic fund, then this SDFC NFO can be a good choice for you. But my suggestion, as you said, 5 to 7 years, it will be better that if you go for hybrid funds in this time period.
Then, Pankaj, first of all, investing in the NFO and then a theme like defense. Should we be adding something like that in our portfolio?
See, now question is very specific because he wants to know particularly about defense sector fund. I mentioned very clearly that instead of one sectoral fund at this time when we are seeing volatility in the market, it will be better to stick to diversified equity or rather balance advantage funds kind of category. But because he mentioned about that, so I just answer to his query.
You there on the phone line? Do you want to ask anything else?
No, ma'am, that's it.
All right, all the best. We quickly move on to Karthik's question. Last question, I don't have much time left. He's currently investing in SBI small cap, HDFC mid cap opportunity. He's planning to add SBI Contra and PPFS Flexi cap. Is the selection right? 15 to 20 years, 5 crores corpus.
For this 15, 20 years time horizon, I'll say that these schemes are good and well diversified portfolio, mid cap, small cap, and value oriented fund. That contra fund is there and flexi cap. He can continue with these funds, and just a calculation to accumulate 5 crore in 20 years, he should invest 27,000 per month and should step up his SIP by 10% every year, so that this 5 crore target can be achieved in 20 years.
Hi Pankaj, that will be all. Thank you so much for being on the show and helping our viewers with their financial portfolio queries. And time to sign off. I'm going to leave you with our WhatsApp number and email ID. Thank you so much for watching. Goodbye.